You choose what you pay for in life, I think. I think that's the mentality, right? You choose to either plan your own trips or you choose to have someone plan it for you. You choose to service your car or you choose to have a financial advisor or you, right. What's your time worth? You can only have so many things that you specialize in life, I think. And if you try to be a specialist in too many things, it's gonna just be a mess.
Today's guest is a certified financial planner, somebody that I've known for 14 years. I'm a client of his, and actually he's also a client of mine, so we have a very good working relationship. Today's guest is Alex Kellermann. Alex, I want to start by asking you the question of finance nerds everywhere, the debate: what is a better account, the TFSA account or the RRSP account?
So the TFSA or RRSP, well, I'm not going to settle the debates. Depends, really.
Okay.
Right? Each one serves a specific purpose, tax-free savings account, money goes in, money can come out quite easily. RSP, it's you really don't want to be pulling that out till you're in a much lower tax bracket, right? So, it's a fine line between, I guess the conversation starts with what's your goals and what are you saving said money for, right? And then you kind of mix and match hey, I should put this much into this account, this much into this. But ideally, you max out both, right? But,
okay. So safe to say that both the TFSA and RRSP should be maxed out before somebody goes to non-registered investment accounts?
Generally, 99% of the time, yeah.
Right. And the rare case would be someone's choosing to save or is choosing to defer the contributions of their RRSPs to the future.
Defer their contributions, or if you're looking they want to upgrade on a house or do a big purchase, you don't want to be stacking away cash in an RSP that you have to pull out in 2 years' time, right? So you really want to establish what am I saving this money for? Like I said, there's various goals. RSPs though, you can put money in, you don't have to claim it in that year.
Right, you can put it in just to get it invested.
Yeah.
Especially if you're someone that just that's your main investment account is your RRSP account.
Yeah.
You can choose to put it in, but then not claim the contribution till a future year.
Correct. And that's basically you getting tax deferral on the investment rather than holding onto it in cash or in a non-registered investment where dividends, interests are taxed actively throughout the year.
So I'm realizing because we are finance nerds and we know this stuff inside out, let's maybe take a step back and can you explain in simple terms what is the difference between a TFSA and an RRSP account? Yeah.
So, acronyms too. So TFSA, tax-free savings account, RRSP, registered retirement savings plan. So they're considered the two registered accounts. And when I say registered, what does that mean? Those are basically the two accounts of the Canadian government. Very few tax advantageous accounts they will give you because they're going to try to take their taxes at every other place, right? So tax-free savings account, you put after-tax dollars in. Any growth in the tax-free savings account is tax-free, as it implies, and you can withdraw from your tax-free savings account at any point without having to owe taxes. Now, the tax-free savings account, since you were 18, you start gaining contribution room.
Yep.
This was introduced in 2009. Yeah, you were 18 in 2009.
I know. I was lucky year to be 18.
Yeah, I was 17, so I had to wait a year. So I have less. So.
Oh, interesting. So you technically have a lower contribution limit than I have.
Yeah, you have 95,000, and I have 90,000. So because I missed out on that 2009, you gained 5,000 room, and I was not 18 yet.
Right.
So, anyways, you gain room. If you don't use it, you don't lose it. You can. If you don't have money to put in that year, it carries forward into the next year. And if you take money out the following year, you can put that money back in, whatever you took out, plus your next contribution room. So the TFSA is a great account for a few things, like wealth accumulators, like people I guess ourselves, I would put it into, that are trying to build their retirement funds or whatever.
Build the nest egg. Accumulate tax-free growth.
Yeah, it's great because you accumulate, and it has the flexibility. If anything ever happens, you need to take out money to, like I said, upgrade that, move into a nicer neighborhood or do anything. It's accessible. When we start talking about retirees or people that are entering retirement and they're starting to think more about, okay, I know I've saved enough, I can live the life I want to live, but I want to be able to pass on some of my nest egg, to create a legacy to my children, my grandchildren. then the TFSA becomes such a valuable tool to pass it on, because you can name direct beneficiaries on tax-free savings account that would bypass your will, which essentially means it gets settled very quickly without any taxes.
We avoid probate.
Avoid probate. Probate's only 1.5%, but
still,
it's
get your hands off my money.
Yeah, exactly. It just keeps it clean, right?
So basically, you're saying not only is it a good mechanism for tax-free wealth accumulation, it's a good tool to use for passing on your wealth to your next of kin.
Yeah, legacy planning.
Planning. And with the TFSA, I'm aware of this unique feature called a successor holder.
Yeah.
Can you explain what that is?
Yeah, great question. So successor holder is unique to the TFSA or tax-free savings account, where you can name your spouse. It can only be your spouse or partner as a successor holder. And what that means is if one of the spouses passes away, the last surviving spouse basically inherits, or it rolls over the tax-free account to that spouse. And then the surviving spouse does not have to liquidate that TFSA. They don't get double contribution room or anything like that, but it allows that TFSA that's rolled over to continue to grow tax-free if that second spouse or surviving spouse, outlives or lives another 20 years. Like 20 years of tax-free sheltered growth, if the spouse that passed away grew that TFSA to 150,000, think about that. That's a huge amount of growth every year.
Right. And so basically, if you pass away and you named your son as the beneficiary, they get that cash out of the TFSA completely tax-free, and it skips the headaches of probate.
Yeah.
But if you name your spouse, not only do they get the proceeds, they retain the value of the account itself
in that bubble,
in the shelter.
Yeah.
And if I pass and then my wife gets my account, she's no longer getting the incremental contribution room each year that I would have got.
Yeah.
She still gets hers as the living spouse,
of course,
but doesn't get mine from my account, but keeps the tax sheltering so the growth stays.
Yeah, and she doesn't have to touch it, which she can, but she doesn't have to for another X amount of years, right? Typically what you want to do, and every situation is different. Like all of this conversation is catered to the typical, but you have your spouse as a successor holder, but then you can name secondary beneficiaries on that same account, and you can have your two adult children as a secondary. And what that helps is just the 1 in a million chance where both spouses
pass at the same time,
car accident, whatever,
I've heard you use let's move on from that grim topic and let's stay back in the happy land of tax savings.
Do we want to explain RSPs, or are we?
No, it's not done yet with the TFSAs.
Okay.
Because I'm in the camp of that thinks that the TFSA actually is a stronger vehicle.
Got it.
I think more people know about RSPs. I think RSPs are more pervasive and larger because they've been around longer.
Yeah.
But I think for someone who's really focused on wealth creation, and somebody who expects to be, who's for folks that are planning to be in the highest income bracket for the rest of their life.
Yeah.
We'll get to it, but RSPs are kicking that tax bill down the curb.
Exactly.
Whereas TFSAs are actually, you don't have that tax bill until the government changes and they take it away.
Yeah.
Which hopefully
they don't.
So I want to use, I've heard you use I think it's a car garage analogy, because I think I've had clients have asked me where by the phrasing of their question, they're confused of what a TFSA is. They think it's one specific investment account, when actually a TFSA is a shelter that can include multiple accounts. So can you use that car garage analogy? Do you know what I'm talking about?
Yeah, I know what you're talking about. Good. So all of these, the tax-free savings account, the RSP, any other, a non-registered account, if anyone's ever heard of those, think of those as garages, okay? And the investment is the vehicle. You can park any sort of vehicle into that garage that you want. Lots of people seem to think that tax-free savings account, TFSA, it can only be invested with cash. You can only hold cash in a savings account. Well, no, you can have cash in a TFSA, you can have stocks in a TFSA, you can have mutual funds, you can have ETFs.
You can even have mixed shares.
You can even have mixed shares, like a Hosper Mix. Yeah. So you can, all of those Hosper Mix, stocks, those are all vehicles. Mm-hmm. The TFSA is the garage. Mm-hmm. You can park whatever you want in that garage. The RSP is a garage. You can park whatever you want in that garage.
So not only different types of vehicles, but multiple vehicles. You can split up your garage. let's say you've grown it to 150,000 as the example you've used.
Yeah.
Okay, that's because someone who was 18 in 2009 has accumulated $95,000 of contribution room.
Yep.
But any growth that you've experienced in that garage grows that garage.
Exactly.
Okay? So 150,000 is a very reasonable amount of growth if someone's been contributing consistently, right? And we even looked at those articles where people are over $1 million in their TFSAs.
Yeah.
Okay, cool. And then I guess my next question would be then why name it a TFSA? Why name it a savings account?
I don't know. I wasn't part of the decision.
They didn't call you when you were 17?
They didn't call me when I was 17 and just fresh going to university. I don't know. I've never actually gone into a deep dive, but it is misleading. Tax-free savings account, misleading, because the biggest benefit, as you said, of a tax-free savings account is not to think of it as a short-term vehicle to put money in and take money out.
Right.
It's for those longer term, because the longer you hold something, as most people know, the bigger the gains, right?
Yeah, so it probably should have been called something like a tax-free registered shelter or something like that.
Yeah, tax-free sheltered account would be nice.
Tax-free.
Nice.
Hey, that almost is the same acronym. They could just change that.
It might cost the government a lot of money to still change it. But
our government only $17 billion to make that change. But I think that the point is getting across. The TFSA is a sheltered account. Okay, I think the next thing that let's contrast it with the one that maybe folks are more familiar with, which is the RRSP.
Yeah.
So let's before we try to then go back to the debate of which is better. Or in which circumstances would either be better. What is a RRSP?
RRSP. Yeah, so Registered Retirement Savings Plan for the acronyms, but RRSP is obviously nicer off the tongue. So what an RRSP is you put money into an RRSP and you get a tax deduction that you can claim on your taxes to essentially get a tax refund. And you can do that. You can put money into your RRSP, as I mentioned, and claim it for that year, which is very typical. And the amount that you get back is based on your marginal tax bracket, right? So most people know this, but the Canadian tax system works in a marginal tax bracket system. So the first $15,000 you technically make in Canada is tax-free, 0% tax, and that makes sense, right? Like if you're making $15,000, you should
keep all that.
You should keep all that. That's you're literally pinching your pennies.
Yeah.
And then the next bracket, you're charged 15% tax and so on to where you're making over 220 something thousand. Every dollar you make over that in a given year, you're taxed at 53.53%. So the benefit of putting the RSP is you get a tax refund based on the marginal tax bracket you're in. So if you make $300,000 a year and you put $1 into your RSP, you get 53 cents back because you're in that highest tax bracket, right? Then once it's in there, like I said, that's the garage, and you can park whatever vehicle. You can invest in Hosper MIC, mutual funds, stocks, whatever you want. And then that grows tax deferred, which is not different than tax free. Tax deferred means the taxes are eventually going to be owed, which is a big thing to remember. And then you can pull out of your RSP, but it gets added onto your taxable income. And the amount of taxes you owe, once again, going back to marginal tax brackets, depends on how much you made that year. The whole premise, if just to simplify it, of an RRSP, or the whole benefit is when you're in your working years, typically you're in a higher tax bracket. Those are your, let's call them your golden years or whatever you want to call them. So you're basically getting the 50, you're in your whatever tax bracket, you get, let's call it 53 cents back on the dollar. Then when you retire, whatever that 55, 60, you're not making much income, if any at all. Like you have some pensions, maybe whatever, but you're not making near as much as you did when you're working.
Or you're presumably not in the highest income bracket anymore.
Yeah, you're not in the highest income. And then when you pull out the money from your RSP or from your RRIF, which is another acronym, but it's what an RSP eventually becomes, not to go down that rabbit hole, then you essentially pay the tax rate at something much lower. So the delta or difference of what you got back versus what you are paying when you take it out is essentially the benefit.
So if used to simplify it, if used perfectly, as you're reaching your peak earning years, you are reducing your income in those years by contributing to your RSPs up to the maximum
and doing
that you're
something
allowed,
with it
and getting it invested. Ideally that's a double win. Right. But even if you're, let's just assume double win there, and then so you've reduced your income in your higher earning years. Then as you get to the like retirement stage where your income should theoretically, if you're following this normal curve going down, then you're raising your income in that, but you're kind of normalizing your income so you don't have the really high income earning years towards the end of your career, and then the lower income years you're spreading out your tax burden.
And that's where you're kind of balancing or managing your taxable income levels. And that's where like some planning takes place, because you're not forced to take out of your RSP. Like your RSP turns into a RRIF at 71, and you're not forced to take out of your RSP or RRIF till 72. So the mistake some people make is like, waiting until they're 72, and then that large RSP is now you're forced to take out a minimum.
And they could have been taking it out earlier theoretically.
And that minimum jumps you into a higher tax bracket than you ever needed to touch in your 70s, because between your retirement at 60 and 72, you never kind of looked at, hey, if I take a little bit of a tax hit now versus a larger tax hit later, and kind of redisperse those funds into your tax-free account or not like any other investment account, or just spend it, like that would reduce my lifetime taxes. So what we're trying to do is like the appropriate type of income spreading, spreading over time. The government doesn't want you to be splitting income with spouses or spreading it across your family. They've kind of clamped down on that. But the legal loopholes, so to speak, that remain are these different types of vehicles: the tax-free account, the RSP account, and you're talking about to minimize, to mitigate the tax as much as possible. You want to spread it out as much as possible to always stay in the lowest tax bracket possible, yet still meeting the requirements to live, because you need to take enough money out to live, of course, but then also meeting the requirements of what you're mandated to take out once your RSP rolls into a RRIF. Why don't we explain that? Why don't you spend like just 1 minute on what is a RRIF and why does the government mandate your RSP to roll into a RRIF at age 71? So RRIF, Registered Retirement Income Fund, is the acronym. And what happens is at age 71, if you have any RSPs, if you have 1 or 10 or however many you have, all of those RSPs will be converted to a RRIF. And an individual, like 1, 5, or 10, however many you hold. And then at age 72, that RRIF, the first year, it's a full year of existence, there's a minimum that needs to come out, and it's based on your age. I think at 72, it's about 5.2%.
I can confirm.
There you go. And it's based on the value of it that's in that RRIF account as of January 1st of that year.
And that's the government's way of making sure that those wealthy Canadians that have accumulated $1 million plus in their RSPs actually start to take it out, so that they can actually start to tax you on that money, because they only tax you on that money when it comes out.
Exactly. They don't want you just, if you don't need that RRIF, they're going to say, well, we want to get a piece of those taxes right now rather than waiting another 20 years, because everyone knows money in your pocket now is typically more valuable than money in your pocket 20 years down the line, right? So that's the government's way of saying, we've given you all these benefits throughout the 30 years you've been putting into this account. Now it's time to start paying some taxes on this.
Because somebody who's in their 70s, maybe in 1990s, they were working and they made $100,000, again to use that simple example, but they were able to contribute 18% of their salary to their RSP. So that year when they made $100,000 of gross income, they contributed $18,000 to their RSP. So that reduced their taxable income in that year from $100,000 to 82. Thanks, you. I could tell you were concerned I was going to get that math wrong.
Like, oh gosh.
So in that year, they only paid tax on 82. So they were never taxed on that $18,000 back in the 90s. So now the government's saying, okay, well, we gave you 30 years plus to let that money grow for you. So you basically, we let you on loan keep your own money. But now we need the money back. So you get the benefit of reducing your taxable income in the higher earning years to a lower amount, but then you also get the benefit of using what you would have otherwise paid to the government to have that money grow for you. So it's like almost, I think of it like a reverse loan. Like, let me hold on to this for a little bit longer. Essentially interest free from the government. Essentially. Right? And they'll defer the tax consequence to later. Now, obviously, I've heard people with, there's a range of opinions. There's also a range of speculations.
Some people hate the RSPs.
People hate the RSPs. People think, what if I don't pay my tax now, and then when I have to pay my tax rates are 80%, 70%. Well, then you should have just paid it when it was 30, 40%.
Hard to know.
Impossible to do that.
Yeah.
And you also kind of have the power of compounding and math working in your favor. Even if the tax rates are that much higher, then you have, depending on the age, like 20, 30 years to have that money working for you.
Yeah.
Where you could more than double that money in the meantime.
Yeah, and it's like it also takes like monitoring throughout you building your RSPs. Like there's a point where your RSPs can get too high, right? Like, and then you want to look at alternative vehicle or garages, if we're putting it like to invest your money. But that takes like, you just need to proactively monitor. You just don't want to blindly throw in RSPs till you're 60 and then be like, oh, what's happening? Retirement's like a weird thing. It's like your people, typically they're so used to getting a paycheck, and then what do they do with that? And then all of a sudden retirement comes, and now all of a sudden they are their own boss.
Yes.
They're their own employer. Like they're deciding how to, where do I've accumulated money here. I'm getting money from here. Like, where do I pull this money? And it's like a totally new thing, right?
I want to come back to the TFSA RRSP conversation because there's so much value there just because of how frequently I see these accounts mismanaged or underused.
Yeah.
But you brought up something interesting, like the shift in mindset from when you're working to you're retired.
Yeah.
Do you, like, what is that, what would you advise to somebody who's going through that shift? Like, how do you have to think about your finances differently when you're in your accumulation years versus when you're in your like wealth preservation and like retirement years?
Yeah, it's funny. It's because I see that a lot with like our client base, and the shift. Honestly, the biggest shift that for clients, like because money is psychological, really. At the end of the day, is they've spent all these years not so pinching pennies, but like, hey, we need to save X, like working towards this goal of accumulating X amount so that they can retire. Now it's their turn to essentially spend it, and that's hard to make that switch. You know what I mean? It's hard
to reprogram your brain if you've been for 65 years. You've had this culture or habit of saving.
Like pay yourself first, like save because you're working towards this inevitable retirement goal. And honestly, some of the most successful people, not just clients, are the ones that are like, the ones that are the most focused on that goal of like saving. But some of the biggest challenges they have is switching it from, we've saved all this, now it's time to enjoy it a bit. Like, and they're still in that mindset of like, oh, I can't buy the extra dipping sauce for my side of fries. Like, you can afford it. You work so hard, like spend this money, right?
Right. Yeah.
So that's, I guess, I don't know if that addresses your question.
No, that does. And I guess it's the same challenge that people who have been habitually spenders for their whole life.
Yeah.
And then they wake up and they're like, I'm 50.
Yeah.
And they're counting down the years, and they're realizing how hard it will be to change those habits. I guess the point is habits are hard to change. So the earlier you can ingrain the habits.
What bucket would you rather be in? Bucket A.
Yeah, I'd rather have to learn how to spend my money.
Yeah.
You could probably have some fun with that journey. The other journey of learning how to start saving,
that's tough,
and catch up lost time is really tough.
Yeah, especially because as you know, time, the biggest asset with building wealth is time.
Totally. Yeah.
Biggest asset you have.
Yeah.
Yeah.
Yeah, very, very few times I've had the chance to go back to high schools or elementary schools, and I think the advice that I want to always give somebody is like, start saving money when the dollar amounts are inconsequential. Yeah. Like if you have a goal to save $20 a month, like that's probably not going to get you to your retirement goals.
Yeah.
But if you're learning that habit as a high school or university student, and you have that goal and you can achieve that goal, then when your income changes, you can readjust that amount, but the habits has been built.
Yeah.
So I think that's the key, especially for like, we've got clients. I have a bit of a different opinion on the TFSA RRSPs because I'm so accustomed to dealing with high net worth individuals and folks that have maxed out their account or in the highest income bracket.
Yeah.
That's why I have a bit of a bias towards the TFSA.
Yeah.
But
the ideal would be to max out both, right? Like,
sure. Yeah.
Like
the ideal is
most of the time, right?
Can you ever think of an example where it doesn't make sense to have your TFSA invested?
Oh no, the TFSA
If you've maxed out your RSPs.
Yeah. This is the yeah.
So here's the
even if you have you have clients that, and now this is not the main goal of a TFSA, but you have clients that have like cash, like even like GICs. GIC is another vehicle, right?
Yeah, it's a type of car you could park in the TFSA garage.
In the TFSA, and they're like, oh, I'm just holding on to this because I'm closing on a house, a pre-built house, or we are saving this to help our kid buy their first apartment. Well, like if you haven't used your TFSAs and you don't have other funds, like you may as well just park it in the TFSA, because at least that 5% GIC interest, like if it's just in that savings account, you make 5%. If you're in the 50% tax bracket, you only get to keep half.
Mm-hmm.
Just park it in the TFSA. You basically are doubling your interest on that GIC, because you get to keep all 5%, and you can pull it out. You gain the room back, So there is lots of other functions of TFSA. It's not. I wouldn't call it the ideal. You don't want to use it as the savings account, but like.
Do you think it's fair to say that the government, when they introduced it, probably had middle class Canadians in mind for this vehicle, when in reality it's often used as like a wealth creation tool for like the more wealthy people?
I think that's generally, it's just trending, like any sort of registered account is trending towards the middle to higher net worth people.
Because you're in a privileged position,
income.
because you have the disposable income to have savings accumulated.
Yeah.
And if you have the savings, you're like, well, I might as well put it in these sheltered vehicles.
Yeah.
And then,
Yeah, and if you think about it, like the RSP, there's immediate benefit. So like the TFSAs, if you think about it, like even a more fortunate or well-off account for people to save into, because there's no real immediate benefit. It's more of a long-term game. And when you think about who benefits really from a longer-term gain, it's the people that can afford to put the $7,000 away, whereas your middle to lower class, I don't want to whatever
lower income,
income, less disposable income,
yeah,
can't afford to, like, that $7,000 is basically like a couple months rent, right?
Right. Right. So yeah, that's why
mortgage payments.
That's why you preface when you were explaining TFSAs as after tax dollars, because that's the distinction. There is RSPs, you're putting in dollars. You're contributing. They may feel like after tax because it's your money, but then you're getting a nice rebate.
April the next year, you're getting a nice rebate, and you can use that to then pay off your credit, like whatever, like or ideally reinvest it. But
and then. Whereas if you've done that, if you've done the RSP contribution, you've got your income to a good level where you're comfortable paying that level of tax, and you still have surplus left over to invest.
Yeah,
you definitely should put it in the the TFSAs rather. Excuse me.
Yeah.
I think but
that doesn't mean that RSP should come first, or it's like I said, it's an individual thing, right? But of course, with your scenario, like if they've maxed out their RSP, should they put money? Yes, of course. It's better than keeping it in a bank account. It's better than keeping it in a non-registered investment account. Like a TFSA can serve many, many purposes.
Yeah.
I would say there's a priority list of like how you want to build wealth, like how you should treat the TFSA, but it can be used as even like I said, a savings account, right?
Can contributing to an RSP be used to offset an unusually high income year because of the sale of a house?
Yep.
So this is one example where this is like a super niche scenario, so it's probably not going to be applicable, but I want to use it to help people really make sure they understand these vehicles. Somebody's planning to sell their cottage. Okay, It's their secondary property. They've had it for 20 years. They're expecting really good proceeds from this, right?
Yep.
And without getting into the different tax consequences of capital gains exemption and all that, let's say they're expecting a $400,000 taxable gain that year from the sale of this cottage. Yeah. Now that might be, if they knew that sale is coming up in the next 2 to 3 years, it might actually make sense to not contribute for a few years leading up to that.
Yeah.
So that you can save or defer your contribution room for the year of that sale to then really pull down on that unusually high income year.
Yeah. Or like we talked about, you don't have to claim it in that given year. So even if you put it in, you talk to your accountant or whoever helps you do your tax, and you say, "Oh, listen, I'm going to sell my cottage next year." Well, this year you're showing $100,000 income from your job. Next year you're going to show $500,000 from your job. let's not claim that contribution. It's already gone into the RRSP, but you don't have to actually claim it in that given year. You can push it off,
Right.
which is basically unclaimed contributions, and you can use it. So, and yes, that would make so much sense, because now, as opposed to getting 29 cents on the dollar,
Yep.
you're getting 53 cents on the dollar, because that cottage sale has pushed you into a huge bracket.
Yeah.
And it's just, then you have to, like, it's hard to say for sure, but you say, like that 20% delta, is it worth waiting a year to get the difference? But, like, you know, typically you're not going to make 20% in any.
Right.
Yeah.
So I guess this is the point, right? So the key here that we would want to drive home is we have a lot of uncertainty. I think you and I even did a different webinar where we talked about not knowing one's expiration date.
Yeah.
So that the biggest the biggest variable that would be helpful to actually be more precise in this planning is to know how many years you're going to live.
Yeah.
What's your cost of living going to be in those years?
Yeah.
Because that future is uncertain, we're making educated guesses.
Exactly.
We're using our experience and our knowledge about these different vehicles to say, like, probably contributing is not going to be a bad idea.
Yeah.
Or in light of this thing that you've raised as a client, you know, thank you, client, for telling me you may actually be selling this property in 3 years. We can tweak our plan in response to that.
Yeah, and that's why we try to encourage clients all the time, like, you know, through casual conversation, like, hey, what's new, what's updating? Because it's the hardest thing is, like, a client could think it's inconsequential, because, it's like, I'm selling a cottage in 3 years, like, why does Alex or why does my FA need to know about that? But actually, there's, like, significant things you can do to plan for that, even 3 years down the road.
Right. Well, I think that's to your earlier point, like, people don't know what they don't know.
Exactly.
So then you as an FA, as a financial advisor, how do you have conversations or relationships with your clients to make sure you're getting all that valuable information so you can be giving the best advice possible?
Yeah, it's mostly just about, like, we can talk about systems and everything, but, like, consistency. You want to make sure that you're touching base at regular intervals, whatever that is. And you want to make sure, and this is always a work in progress, you want to always make sure that when you do talk, it's not always business, right? Like, you don't want to, you have an agenda, you have things that you want to add for that client, but some of the best information you get is that 10 minutes before you actually get to your agenda of, like, catching up, like, how was, like, you know, we're doing meetings, how was your Thanksgiving, you know, like, you're with your daughter, like, this daughter had you have another grandchild, like, you know, like,
right,
like, it's just the casual, and that's fun because, like, you get to just, then you start in your head, like, this opens up this door,
right? You can start talking about RRSPs and all that other stuff.
Yeah, or just understanding the client, like, just, you know, you want to see your clients be happy too, like, so
yeah,
it's good.
Yeah, that's interesting. So basically the takeaway there is, if you just treated it like business, and you said to your client, who maybe is not, you know, they're happy they're working with you because maybe they don't want to do this themselves, or they don't have the knowledge to do it themselves.
Yeah.
If you said to that person, what has changed in your financial circumstances, they might not know where to begin.
Of course.
But if you say, what's new in your life? I just got married, or, I just had a granddaughter, or whatever. Like, these are things that you can interpret as having financial consequence.
Or I'm sending my child to daycare for the first time, like, next year. Like, that's a huge.
We want to go to private school.
From your kid, right? Like, do you think that's gonna be a big part of your, like, that's gonna be a big change in your life when you first day of JK or first day of preschool, right? So, yeah.
So, okay, like, at a high level, what do you think is the biggest benefit to someone of having a financial advisor? And I guess maybe my next question would be, like, should everyone have a financial advisor?
Yeah, that's a great common question.
Okay.
So I'll start with your second question. Should everyone have a financial advisor? You know, no, like, simply.
Yeah.
Because, and I'll explain, I'll try to use kind of an analogy. Like, you know, people pick and choose what they want to pay for through their life, right?
Okay.
Like, what expertise.
Right.
And if someone, like, for example, for me, I take my car to a mechanic. I take my car to the dealership because I have no idea about cars, right?
Yeah.
If I was interested in cars and I wanted to fix my own car, and I didn't want to pay for it, then I could do my own servicing of my car.
That would be like the equivalent of someone, like, just doing it themselves.
Doing it themselves. And I will preface that, like, most people that do it themselves are missing something.
Yes.
They can do you can do a fairly adequate job,
Yeah.
right? If you're knowledgeable, if that's what you like to do after you get off work and research and
Yes.
put in, it's economies of scale, right? We do this, financial advisors do this day in and day out. We read tons of news about things changing, and we can apply that to a mass amount of, which is why the job works, because we can apply all that knowledge and apply it in various scenarios and use that experience to cater it to each client scenario. But if someone wanted to do it themselves, it would just take hours and hours and days of
Right.
consistent research. And
and
some
the risk,
people like that.
the risk that they might miss something, but also the upside they're thinking, well, yeah, I might miss something, but I'm going to save potentially money,
Yeah.
which I'm going to choose to do this service myself,
Yeah.
or they truly just enjoy it.
Exactly. And if they truly enjoy it, then they should
So
probably just be financial advisors themselves.
Pretty
right?
hard one to argue. Well, in my world, arranging mortgage investments for people,
Yeah.
I ask myself, why would you want to go out and pound the pavement and find these deals yourself when we're that's what we set up to do. We have this pipeline of offerings for you.
Yeah.
Well, in most cases, they're often retired. They're well, I like to do it.
Yeah.
I'm why would you want to, call borrowers and negotiate renewals? We have a team for that. Well, that's their hobby now. So
Yeah.
I can respect that.
Yeah.
What
is
about
totally fair.
What about the circumstance of someone who's just got a very simple, do you think is that a rationale that would be reasonable? If someone says oh, my circumstances are not complex enough to need a financial advisor?
Yeah, and that's another thing that's shifting about the industry. So if you are just getting started or you think it's very simple, I'm going to put X into this, X into this, there's, if you feel confident that behaviorally, because another role of advisors is basically a behavioral therapist.
A money coach.
A money coach.
A habit coach.
A money coach that sometimes is mean, good cop, bad cop, right? Sometimes you're mean and you're hey, pick it up. Sometimes you're great job, pat on the back. We set out to accomplish this 2 years ago, and look at how far you got. You got that house, or you.
Oh, that's nice.
You've saved right.
So you actually get to reinforce the congratulations when people, because
Yeah.
people might not take a minute to appreciate the work that
how
they've
far
done.
they've come, right? Going from saving $20 when you're young to now you're saving $200 every paycheck, or small amounts still, but
or more, yeah,
or more.
Yeah.
So if you trust that you can behaviorally do it yourself and you have discipline, and maybe you have a friend in the industry that's willing to take your call at once every 6 months to answer the odd question, do you need a financial advisor? Maybe not, but I promise you, those young people, their situation will just become more and more complex.
Right.
And their time will get less and less because they're maybe going to start having families. Maybe job becomes more. Maybe they have a bigger house that things need to get done.
Mm-hmm.
So, and the biggest value that we can offer clients, especially, in an industry where lots of people are old, is we are going to see hopefully most of our clients through for the majority of their life, right?
Mm-hmm.
And the best financial advice you can give, whether it's us, whether it's any other, is knowing your client is inside and out,
Mm-hmm.
right? Because all this money doesn't matter unless it's something that you accomplish something that matters to you,
Right. So the point is, what you're saying is just arbitrarily saving is not the goal. There should be a goal, and savings is
in mind
that you're working towards.
Yeah.
Some family goal or personal goal or security goal.
Yeah.
Or pass it on to your kids.
Legacy
Peace of
goal.
mind.
Yeah. But yeah, so the younger, I get it, because you can go on some e-trading, you can go on some of the online platforms and they're great, they're awesome, but it's you don't get that kind of behavioral therapist aspect, and you don't develop that relationship with someone.
So so starting early, before someone's situation is maybe so complex that they absolutely need a financial advisor like yourself.
Yeah.
By them starting early, you get more time to build knowledge about who they are and what their goals are.
Yeah.
So you can actually do a better job as an advisor, and they have more time building their habits and starting to train their habits so that when they are making, higher income, then those habits become more powerful. Okay,
Exactly.
that's interesting. So kind of when you're describing that, it's kind of like the metaphor of, I guess, doing your taxes.
Yeah.
If your situation is super simple, you can just do your tax online, pay
Yeah.
the $50 or whatever.
Yeah, TurboTax or.
Right. Yeah. But as someone, I have a somewhat complex situation.
Mm-hmm.
I would never dream of wanting to do it online.
Yeah.
So that's where I would say, okay, I'm going to use an expert.
Yeah, you say, like, I don't want to waste 3 of my weekends trying to figure this out.
Right.
Like, what's my time worth, really?
Both what's my time worth and, you know, how much would I pay to not have this stress?
Yeah. Yeah, that's true. Like, your health is also, like, invaluable.
Yeah.
So
then the other thing about the to kind of finish the metaphor, like, even though you have a simple framework, like a simple tax structure, let's use that metaphor again. No one, if you're choosing to e-file it, no one's forcing you to do it.
yeah.
Like, when I was young and my parents' accountant did my taxes for me,
Yeah.
you know, let's thinking back to when I was like 19,
Yeah.
if it wasn't him emailing me saying, hey, you need to send me this stuff, we need to get your taxes done, there's a chance that I would have just not done them, right?
Yeah.
I would have just forgot or put it off or been oblivious to the fact that I had to file, right?
Yeah.
Okay, so that's interesting.
You choose what you pay for in life, I think. Like, I think that's the mentality, right? Like, you choose to either plan your own trips or you choose to have someone plan it for you. You choose to service your car, or you choose to have a financial advisor, or you,
Right.
like, you know, what's your time worth? You can
Right.
only have so many things that you specialize in life, I think, right? You can't be and if you try to be a specialist in too many things, it's gonna just be a mess. Right?
Yeah, well, we're like, I mean, obviously we worked together for a long time. We know each other for a long time. Like, I would consider myself in that kind of like hybrid category.
Yeah.
Where it is a hobby, it is a profession, it's more of like the investing channel of the financial planning.
Yeah.
But then, you know, you and I have talked, and you've helped me when I need something that's outside of my scope, like insurance.
Yeah.
So maybe that's a good time to like pivot to that next branch. Actually, before we get into the insurance conversation, what are all the buckets that financial planning, financial advising cover? We've talked about investing.
Yeah.
Well, it's about to talk about insurance. Like, what would be the other pillars that you would?
Yeah, so we talked about like growing your money or making your money grow,
Okay.
right? Which is investing. We started to talk about protecting your earned income and protecting yourself, which is insurance. We talk about passing it on or legacy planning, right?
Mm-hmm.
We talk about mitigating your tax liabilities, which is kind of tax planning.
Mm-hmm.
So those are the 4 main buckets. We also talk about like cash flow. Cash flow is more.
These are really good buzzwords.
Right?
Someone
We like cash
very
flow.
smart.
Should I look at the camera and say
Yeah.
everyone? Yeah.
No, this is good though. So like these are it's important for. I was not joking. I was not trying to be facetious when I said these are good buzzwords. Like, it's good in that when you can break it down, it kind of helps me and people understand like this kind of gray cloud of financial planning is actually just broken into smaller pieces that are easier to understand. And I like the words that you were using because they're just saying exactly what we're doing.
Yeah.
We're making your money grow.
And all those buckets are more prominent at different stages of your life, right? Like,
right. So earlier on, you're trying to make your money grow. You start to have a family. You start to worry about protecting your money.
Yeah.
You start to get to older in your life. You start thinking about your legacy.
yeah,
What was the fourth one I missed? Cash flow? No, there was a fourth one.
tax liability.
Oh yeah, that's always
Well, that's throughout. But
always
like,
a problem. Yeah.
You know, the more and more successful you get, the more and more complex that tax liability gets too.
Right. Right.
And then there's obviously like, you know, business owners are a whole different kind of bucket because, you know, you're not just managing your personal wealth, you're managing your business wealth, and there's all sorts of structures. I'm probably not going to get too much into it today, but there's all sorts of structures that you can put in place to like help you either transition away from the business or grow your wealth in various corps, like holding corps and all that stuff.
So we'll put a pin in that. I will
Yeah.
come back to holding corps because I interact with a lot of clients that have corps. Some are not entrepreneurs; they just have a holding corp.
Mm-hmm.
So I want to go sequentially here.
Yeah. Insurance.
Let's talk about insurance. Yeah.
Yeah.
So what would you say, like, you know, open book? Where do you start when you start a conversation with someone about insurance?
Yeah, it's tough because you don't want to be like salesy on insurance, right? But you do want to kind of stress to someone how important. Because I'll ask you a question: what's your biggest asset in life right now?
Time.
Time. And financially, if you look at
I thought that was the answer he was looking for. I
Well,
thought he
time's a
wanted
good
me to
one.
say
That's
time
like-
is the number one asset.
That's true. You're short on time, so.
So, but for me,
Yeah.
in my
You
like
look at
investment portfolio,
You look at your financials. You look at everything. We're looking at everything that you've accumulated, and I say, what's your biggest asset? Is it an account? What is it?
so for me, it would probably
Is
be
your house?
It would actually probably be not the house because of the mortgage, but I would say it would probably be like mortgage investments because that's where I've dumped probably. I wouldn't recommend how concentrated I am to someone in mortgages, but given that it's what I'm doing all day, every day, I'm comfortable being really concentrated in mortgages.
Yeah. See, I'm going to throw you a curveball here. I think your biggest asset isn't it's not on the spreadsheet that you have or whatever with all your accounts.
Okay.
It's your future income earning potential.
That's basically time. That's
time.
basically
yeah, you
time.
basically we got there
Okay,
roundabout
good.
way.
All right, good.
Because like you think about it, like we're 33, 34, where hopefully you work, you have Hosper, you're gonna make X amount.
I see.
That is the biggest asset you have. That's worth more than any of your accounts right now.
Your future earning potential.
Yeah. If we had this podcast, if it's still going in 20 years, and we have this at 60, then yeah, maybe it's changed because
then it's my followers on my podcast.
Then that's your biggest asset.
In 60 years, yeah.
The
Okay.
millions, yeah. So how do you protect that biggest asset, and how do you protect others?
Oh, I see what you're
asset?
saying. So you're putting that concept of my unearned income potential in my mind as something I need to protect, even though it's not in my account. It's not something I own today. Yeah. It's something that I should be protecting.
Exactly.
Okay. Well done.
And not protecting, you shouldn't be allocating 50% of your cash flow to it, right? But there should be a slice to protect that future income earning potential and protect your loved ones.
So right? I should put a couple percent of today's income to protect this future income. Okay, and that's what life insurance is essentially.
Worst case scenario, well, it depends what worst. Worst case scenario, something bad does happen, and thank goodness you have those protections in place, whether it's disability, critical illness, or life insurance. Best case scenario, in 30 years' time, we're having lunch and you say, I never had to claim on my insurance. Is that really a bad thing? That means you've been healthy till you're 65, right?
Yeah, it's a pretty good worst case scenario.
Worst case scenario, and you still say I'm very comfortable, right?
And in a lot of these vehicles, you can then still benefit from them while you're still living. You can draw from them. You can borrow from them.
Yeah, those are more permanent. The typical one is permanent life insurance, which is there's a difference between term life insurance and permanent life insurance. Term insurance is you're essentially renting a policy. Yeah, and it's much cheaper, for lack of a better term, to get a term life insurance to say, I want to make sure that while I have Hudson or my kids or anything, while I have my kids for 20 years, I can confirm that those kids will not have to worry about any, if I die, they won't have to worry because there's going to be a lump sum paid to them for their education, for the rest of the mortgage. So that's term. Permanent is when you say, I want to guarantee that no matter when I die, when I pass, whether it's next year or 30 years, 60 years from now, there's going to be an amount paid out. And that in that vehicle, it actually acts as more of an investment vehicle as well, where that benefit can grow over time. And that's especially beneficial for business owners in corps. Okay,
we can go to that topic now. So because we talked loosely about how your money can grow. We talked about some of the registered plans.
Yeah.
We didn't touch on the RESP, the Registered Education Savings Plan.
Yeah.
And
free money waiting in there.
Yeah, so there's free money there, but that's a small one. But
Google it. Yeah.
Google it. Yeah. Google it. ChatGPT it. What's the other ones? The first time home buyer.
First home savings account, FHSA. That one's a nice one.
Also a small one.
Yeah.
But it's important.
It's important.
Google.
Yeah. Google it. Yeah, that one's kind of a RRSP TFSA hybrid, but you can Google it. And if you're looking to buy your first house, I would say that's probably if you're saving specifically for first house, that's probably the first account you want to save into. But,
okay. And then there's also RDSP, so disability savings plans.
Yeah.
And there's locked-in retirement accounts.
But you can't open a locked-in retirement account.
So we're just mentioning them just in case these are the names that somebody can look up on their own.
Yeah.
Okay, good. So, and we didn't talk about, investment allocation. We're not going to spend time talking about, what stocks they should pick or what investments they should buy.
Shouldn't ask me. That's
yeah, that's not the purpose. The purpose is we're talking about the umbrella things.
Yeah.
The things that the actual picking of the investments or where you choose to spend your money, that's later.
Yeah.
We got to build the foundation before we can worry about that stuff.
Exactly.
Okay, cool. I'm following. This is very good. So then we've talked about the protecting your money. That's the insurance. We talked a little bit about cash flow. We talked about reducing your income and putting into future years. The biggest reason I wanted to spend so much time talking about these different plans is that I don't think that information is abundantly available. You know, I don't think like the amount of really wealthy, like high income earning folks, maybe in their 40s, 50s, 60s that I deal with, that just didn't have their TFSA set up. We actually we looked at it. It's like close. Oh, it was over 30%.
That's crazy. You said that in the webinar. That's crazy.
It is to me crazy because like you're paying the tax on non-registered accounts.
Yeah.
So all you got to do is put it in this bucket over here, and you get to keep all of it.
Yeah. Depending if there's cap gains, right? Like if someone's like some people are stuck and they're non-registered.
Sure, but the assumption that I'm making is that these people are actively investing new cash in my R products or in other products, or they're telling me about it.
Yeah.
And when I ask them, like, why haven't you set up a TFSA? A lot of them, you know, no shade to the older folks that are just like, well, that's just such a small amount. And I'm like, what do you mean? Like, oh, it's like a couple grand. And I'm like, yeah, in 2009 it was like $5,000. But like, so I think a lot of people.
Yeah, think about like 95K on 8%, like close to $8,000 of extra income.
Well, that's the thing. I think a lot of people are very surprised now when I tell them that if you've never contributed to your TFSA, it's $95,000. Because they haven't been keeping track of the little incremental, you know, 5,000 contribution in 2009, and then you know the 5,500, then 6,000. But it started to add up to a material amount. Or again, like the article that we wrote, those who have been nurturing it, and some cases got lucky and hit home runs within their TFSAs, now are wielding these $7-figure, $1 million portfolio in your TFSA. Which if you just put in something very passive at 8-9%, you know, you're making $80,000, $90,000 like tax free, right? And that's you know, when you look at tax-free equivalent to after-tax dollars, that's like a very substantial salary that you can essentially make in addition to your salary.
Yeah.
Okay, I will get off the TFSA. I just cannot believe how many people are not using it, and I just think that it is an extremely powerful vehicle for wealth creation, and I really just want to beat that drum like really, really hard, which I think we've done though. I saw a really interesting video, shifting gears now, on YouTube, and it was talking about, it was in America, how people that make, you know, 20,000 live and where their expenses go, and then looking at the same thing for 40,000 annual income, 100,000. Then I think it went up to like 1 million and 10 million, and just showing like how different ratios of where money's being spent and saved. So without going to those extremes, I want to ask, like, imagine somebody that has $100,000 of net worth in our business, net financial assets. So we're going to exclude like value of real estate, just investable cash. I'll get to it, but we'll start with 100, then 500, then a million. Like, how does your recommendations, or what sort of things would be different? Where should someone with 100,000 look first, and then we'll get to the 500, then a million?
To invest, right? We're talking about.
Yeah, we're talking about to invest, or it could be to buy insurance, or it could be to, you know, what is someone, if they're sitting in their, you know, looking on their Wealthsimple account or wherever. Well, I'd like to bleep out Wealthsimple, but look on their Wealthsimple account, and then they see 99,800. Like, where should that money be divided across the shelters we've talked about, or like what type of asset class should they be looking at? Like, you as a professional financial advisor, like, what are you telling that person? So, you know, I'll just like, depending on how much you have to invest, it opens different doors, and it goes up and up and up, right? So like the 100,000 person, like, we'll start from the kind of the lower end of that. You know, there's no question you should just be focusing on your registered account, your TFSA, and your RSP. And depending on FHSA, RESP, like, you should only be focused on registered accounts. But all of those registered accounts have caps, right? So when you deal with more money and you have more money, then all of a sudden, and you've hit all those caps, then all of a sudden you have to allocate to certain different accounts or different goals in mind, right? So the 100,000 person, you know, depending on their goals, where they're saving that towards, like, just think of all those acronyms we just told you about: FHSA, RRSP, TFSA, RESP for kids' education. Yeah, so you'd ask, what are your goals? Yeah. And if the first thing that comes to mind is buying your first house, probably the FHSA is the first one. If you're really thinking about your kids. But that has a cap of like 8,000 annually, right? So like we're down to 92,000. So you know what I mean? And that's good. And then the RESP, that's another one. Yeah. That has a cap as well. Yeah, depends on how old your kid. But like 5,000 is the max you want to put in any given 1 year to catch up on the past year's
grants. Like, so there's caps, right? And then, you know, maybe not necessarily all throw it into the register accounts right at once, because maybe you want to hold some money back to put into these accounts as more grants come up, like the RRSP and the FHSA, right? But really, over the next few years, if you have 100K, you want to just build on capping those out.
So in layman's terms, if you're getting started in investing, or you're starting to accumulate some savings, the first place you should be looking is the registered plans.
Like, yeah.
Okay. Now let's just, for better contrast, you know, let's skip the $500,000 range. Let's go to $1 million. You're somebody I'll paint a little scenario for you. Okay. You own your own home. You're in your 50s. You've managed to save $1 million aside from your principal residence.
Yeah.
Now, what questions are you asking, or where's that person looking for their $1 million of net financial assets?
Yeah. So once again, like the 100,000, we're gonna, like, you want to generally cap out all those tax advantageous accounts that you have.
So with $1 million, someone who's been consistently maxing out their RSPs, they've saved $1 million in their 50s, so they've probably had the $7,000 a year to put in their TFSAs.
Yeah.
So what now? So
you want to, like, now I'm making some assumptions here, but that $1 million family or person is typically you're talking about a house. Maybe you might have a mortgage now. You might have liabilities. You might have family, like you might have kids, or you might have people you care about. You know, then you look at the protection aspect. Not to say that 100,000 doesn't need to protect themselves, but now you're dealing with more and more money, and I'm assuming also that person or that family has, you know, the next 10 years to keep that growing. So how do you protect that future income and protect what you've grown? So now you start having, like, you know, more necessary to have that protection aspect, and allocating a very small portion, a couple percentage points to a monthly or to whatever, to putting towards that protection aspect to make sure that you've worked so hard to build this up to $1 million. You know, if everything goes right, you can be fine. If everything goes wrong, it can put this plan to the dirt, basically. It can crumble. So why don't we look at the scenario where we put a little bit of that towards protection, and then if we can say you'll be fine, even if we allocate 5-6%, you'll be fine, then it's better than scenario B where everything goes down.
So we want to allocate enough that, okay, if we didn't need that 5% that we allocated to protection, and we'll have a little bit less in the future.
Of course.
But we'll still be good.
And then we've covered all the bases in case everything goes super wrong. Right. And then you look at, okay, like that's covered. We'll check that off the box, and that needs to be looked at and then if we still have, and we, you know, you go through the projections, you're like, you know, you're going to have excess money. How do we start looking at establishing a legacy? And that typically doesn't start till retirement, because everyone's so focused on building, and they don't really know what their life is going to be like when they get that 50, 60 hours back a week and they start paying themselves. But that's like the best legacy planning doesn't happen in your 80s or even in your 70s. Like, it happens in your 60s, your 50s, right? So you start, not necessarily, and when I say it's very broad, like to legacy planning, there's a few ways that you can do that, like permanent life insurance, or, you know, if your kids are of age and you have that serious conversation with them, you can start giving it away while you're living to put in their TFSA, right? Like, if your kid turned 18, they have 7,000 of TFSA room, right? Want to help them with that. Buying your child has a principal residence exemption. Everyone has one, you know. Why
help them buy their
help them and get into the real estate game? Real estate's so expensive, especially in the GTA, right? Like,
okay. So
can I say one more thing?
Of course.
People are we mentioned habits. Like, habits are hard to break. The $1 million person is probably so used to just accumulating. It's so hard to convince them that, hey, and I don't even, like, the $1 million, that's probably not enough to buy their kid a house, but, like, let's say they have more than enough to live. So hard to convince them that, hey, that's our job. You're gonna have so much money left over. Why wait another 30 years to give your kid this money when it could be growing in your kid's name in a condo, in a principal residence, tax free? Get him into the or whatever.
So that's another, like, legal type of income spreading that we talked about, legal loopholes, right?
Yeah.
Where you could, someone who's you're in your 50s. Well, let's use the last example that I'm going to. Now I'm going to say you're someone with $10 million. Okay, so this is for sure true of someone with $10 million.
Yeah.
If they have younger adult kids,
Yeah.
it totally makes sense to help them get into the housing market or make sure their TFSAs are maxed out. You can even do it on a loan. Yeah. Right. You can even do it on a loan basis. Like, have you seen that with? Yeah. You've definitely seen that.
Yeah.
Right?
Yeah, but you don't that's just them covering in case. Usually it's typically because if their adult child is with a partner and they want to make sure their side's protected, kind of thing.
Yeah, naturally. Okay.
You know what I mean? And then so it's not like all of a sudden
But I suppose so that would be a very logical reason to paper that type of gift. But even if you felt like, as someone who wants to raise children who are not, getting handouts, or that they're actually working for it, you could even structure it as a loan.
Exactly.
The point is, I guess, what we're making is you only have one TFSA in your life.
Yeah.
But each of your family members who are over the age of 18 would have their TFSA as well.
Yeah.
You only have one principal residence exemption.
Yeah.
Your other adult family members have those as well.
Yeah.
So if you're already thinking about legacy and how you're going to give this money to your kids when you pass, this is a way to do it earlier. That actually gives them more time, which we talked about as a very powerful thing, to start accumulating that wealth in these vehicles.
And the fun part is them coming to that realization, right? Leading them there to say, hey, look, we've crunched the numbers. We have shown you that this amount is going to lead to this amount over time. You've clearly told us on the high end that you need to spend X amount, and you want to take your family trip. Let's bake in all these numbers, and if the numbers say you're going to still have X amount of dollars left over plus your property, why do you feel comfortable? Can you feel comfortable giving a little bit away now? Mm-hmm. Because people can't understand that if it's just a number on a paper. If I said, James, you've built up $1 million, I can tell you, or you built up $5 million, I can tell you can start giving away now. You'll be like, well, I don't believe you, right? That's a common response. But if I say, James, let me show you what the next 30 years might look like financially. Especially
if people have that scarcity mentality.
Yeah.
Of I need to save. I can imagine it would be hard, even to your kids. Hopefully, through conversations like this, we'll be able to feel more comfortable.
Yeah.
Being able to give when you don't need it.
Yeah.
Okay, that's good. What we've covered a lot. So then I guess the last bit about the individual who's got $10 million, I think that I would want to say on that, because we didn't talk a lot about different asset allocations. That's the next step after this general framework conversation.
Yeah.
But I guess the thing is, when you start to get to that level of wealth, you do start to have access to different types of investments that are,
of course,
you start to see more people owning businesses. That sort of makes things more active business income. You can get returns on businesses. It's like anything in investing, higher risk, higher rewards.
Yeah.
So starting businesses or owning, apartment buildings as opposed to owning, your rental property.
Yeah. It's not all your eggs in, the advice would be not all your eggs in one basket, but, lots of people have been rich by having all their eggs in one basket. So,
right.
But I think it's hard once you've reached that point. You want to de-risk it, and if you've done really well in one specific asset class or one, eventually you should reach the point where you're like, you know what, I've reached the point where I know I can make this last for a long time. Let's start diversifying a bit, right?
So that's an interesting point. I want a little thought experiment here that I was thinking about yesterday.
Yeah.
Putting you on the spot a bit. If I said we're going to get our friend Sam over here filming to pick a number between 1 and 100.
Yeah.
Okay? I'll let you pick. We'll play for $1.
Okay.
Okay. I'll let you have 60 of the numbers you can choose, and I'll have 40. Would you take that bet?
Yeah.
Why would you take that bet?
Because I have a 20% more greater chance of winning the $1.
Yeah. So you've bet. Okay. What if I said same example, but let's play for $10? Would you take that bet?
Yeah.
Okay. What if same example? What if I said let's play for $200,000? Would you take that bet?
Me personally, probably not.
Right. So and me too. I don't know. I would be like, I don't know. Even the number could be different or whatever.
Yeah.
When I was thinking about it, when I was talking to Lindsay, who didn't quite enjoy the analogy as much as I think you might, we talked about $1 million. even if someone's like, you can have 80 of the numbers,
Yeah.
which I would do no brainer for $1 or $5 or $10 because it's just such an overwhelming like of odds in my favor.
Yeah.
What changes in that when the number gets so big, and is there any parallels to financial planning you can think about with respect to that?
That's a good question.
Because like the reason that this popped back into my head from yesterday is when you were talking about protecting your savings. Like, let's say you're that person that's accumulated $1 million, or in a last example, $10 million.
Yeah.
Like, it's a lot more important to make sure that doesn't go down from 10 million to 1 million than it is to make sure that that goes from 10 million to 100 million.
I agree.
Like, protecting the downside when you're comfortable and you've met or on track to meeting your goals, it's a lot more important to make sure you stay on track to meeting your goals than it is to make sure you exceed your goals by, 5x.
Yeah.
So I think that's it. But that's a really interesting thing about human nature, that something that is rational and logical, like it makes sense to take that bet.
Yeah.
But then there's something that stops us when the number gets uncomfortable.
I think I'm just thinking like money's so much, money gets easier and easier to make the more money you have, right? Whether it's through investments, through growth, like 10% on 200,000 is 20,000 as opposed to 10% on $2,000 is like a measly
$20.
like $20, right?
Yeah.
So I think that goes to your, like, why are we saying no to the 2,000 even though the odds haven't changed, or 200,000 even though the odds haven't changed? Because like getting that back up to 200,000,
it's so much
is
harder.
so much harder.
Right.
Then
the
like,
risk of losing that is so great.
Yeah.
Then even okay, I think we're getting close to a little sniffing around a little answer here. The risk of losing 200,000 is so much more detrimental than the benefit of gaining 200,000.
Exactly.
Yeah.
Yeah, because using that 200,000, not playing your betting game. If I say like, screw you, James, I'm not playing your betting game. Making that 200,000 on 200,000 will take X amount of years. But if I lose it, building up to that 200,000 is going to take, I guarantee you, like 2 to 3 times longer than making that next 200,000. Like you see those charts, like my first million took me X amount to make, but then my next million, it's so much shorter, so much shorter, so much shorter, so much shorter through anything that makes your money work for you, right?
Yeah.
So
yeah, you're leading me into my favorite topic of compounding, which I could probably go on.
The Hosper slogan.
Yeah, no,
but
I think, well,
one of
passive
them?
income for active living is.
Oh, there you go.
Thank you for acknowledging. No, compounding is a super powerful thing, and I think like what we're trying to do with these podcasts is like the compounding of knowledge.
Yeah.
So if we're not gonna have all the answers on this short clip, like, hopefully someone sees like a 1-minute clip that just we listed off a bunch of acronyms.
Yeah.
But then if they can then take that and do a little bit of research, which then compounds into actually having a conversation with you or their financial advisor or their family, which then compounds into them actually doing something, which then compounds into the actual growth there. Like that's the level of compounding that I think is so fascinating in money, but also applies to things like skill building and learning and stuff too.
Life.
That's life. Great. Well then, Alex, I want to thank you very much for spending the time talking with us, sharing your wisdom as a financial advisor, and we covered a lot of stuff. I look forward to having you on the show.
Are we doing a handshake or what?
Let's do a handshake.
Give me a handshake. There you go. Sweet.
All right, cut it.